in. So today, yeah, like Laura mentioned, this is fundamentals of financial management. And so just a little bit about myself. So Ross Smith, I'm been a SCORE mentor for about 5 years, maybe a little over that at this point. Currently, I work for Bridgestone, big, large tire manufacturer, global. And my experience is in accounting, finance, strategic planning, and my latest gig within Bridgestone is within sustainability. So I do have an MBA in finance at the University of Akron. Hopefully, there's some other zips on the line here, and a bachelor's in accounting. So what is SCORE? So our mission is to foster vibrant communities through mentoring and education. And our vision is for every person really to have that support necessary to thrive as a small business owner. We think it's so important for business owners to have the tools in hand and the mentorship to actually make their businesses successful. So that's our vision. And in order to schedule a meeting with a local SCORE counselor, there's a couple of ways to do that. One is through our online portal, so akron.score.org, or you can call the office at 330-379-3163. And we would love to hear from you. And again, we can set you up with a mentor to help you walk through some of the things we'll talk about today. And just another plug for some of the SCORE webinars that are actually out there on the URL here on the screen. We'll deliver this to you later, but we have a lot of webinars that we've done, and these are on demand. And so there's a lot of learning you can do on your own as well, whether it be marketing or strategy or technology or human resources, just a lot of webinars that you can use here to, um, to learn and make sure you have the skill sets to run your business. So let's jump in. So today we're going to talk about first building the financial plan, very important. We'll talk about bookkeeping briefly and try to demystify the financial statements for you, because I know, for small business owners that don't have a financial background, financial statements can be a bit overwhelming. So we'll try to demystify those for you. And then probably the most important is, once we put our financial plans together, how do we actually compare to how our business is running on an actual basis? So very important as well. So let's jump in. So to kind of differentiate the financial plan from the business plan. So the business plan is really all encompassing for your business. So it starts with the company structure, right? So how is your company going to be structured, whether it's a partnership, an LLC, a corporation, but it starts there. And then we put a plan together of, what are our products and services that we're going to sell in our company? And then the marketing plan behind that to actually market those out to the customers. How are we going to manage our company? How are we going to manage the operations and the people and all the pieces and parts for our business? And then what equipment and inventory, what tangible things do we need to actually, produce what we're going to sell? And what inventory do we need to build in order to service our customers? Then we have taxes, insurance, regulations, very important as well. Whatever business we're operating in, regulations can actually be a pretty big area that we would want to put in our business plan. And then finally, finances, probably the most important in my opinion. And so that financial plan is part of the business plan. Obviously, it's the last bullet there. And it converts information from our business plan, from our marketing plan and so forth, into dollars. And so we can actually see financially how our business is going to do going forward. And then it estimates net income and our cash flow over time. And we'll talk about that in a minute. And this is appropriate for not only startups, very important, but also existing businesses. I can speak from my experience within Bridgestone. We do a financial plan every 3 years, and it's very in-depth, very, cuts across the whole business. So not only are small businesses doing this, our large corporations are also doing this. And so building the financial plan, there's really 5 areas that we look at. And starting to the left, it's, we look at the cost of our product and service. So what are we going to charge for what we're doing? Operations, how are we going to operate, manage our business? Sales forecasts, how many of these widgets are we going to sell? And how are we going to market those out to the customers? And finally, what cash requirements are out there that we're going to need to either invest in our business? And what loans may we need to take out to run our business? And all of these encompass the financial plan that we'll talk through. And so who needs a financial plan? So anyone starting a new business, very, very important. This is probably one of the, if not the first thing, probably one of the first things you do. You want to understand your sales and profits for the next 5 years. You'll need your financial plan if you want to apply for a bank loan. And if you have business partners, you'll want to build this with them to have a concrete understanding of your finances of your business going forward. And maybe you want to expand your business, right? So you may want to judge if this expansion makes sense. So very important to have a financial plan there. And again, if you want to apply for a bank loan, your bank's definitely going to want to see your business plan and your financial plan. And if you're running a not-for-profit, you may want to apply for grants and some of your IRS filings where you'll need a financial plan. So again, very, very important. Can't stress that enough. And so why have a business plan? So it really improves the chances of success. It's some pretty interesting stats here that there's about 630,000 businesses starting it every year, and 95% of those end in failure, which is sad but true. And a financial plan, a good business plan, can really help you improve those chances. And so why do businesses fail? So 82% lack of understanding cash flow, which cash flow is probably your most important, especially starting up, because if you run out of cash, you run out of your business. Starting with too little money, so maybe there's a loan you need to take out early on. Maybe you need to invest a little more money up front. Not pricing products properly. I can attest to this when my wife has a small business, and I'm constantly reminding her that, hey, we need to price these products appropriately. So that one's near and dear. Also being overly optimistic about sales, and so overly forecasting and being too optimistic about what we can actually do. And lastly, 70% not seeking help, right? So that's where SCORE comes in. We can really help you with this through our mentors and make sure you're on the right foot as you go forward. So we'll look now at a quick example of a company. This is a personal training company, Personal Training LLC, that is starting up. And so they're going to provide personal training sessions to clients within their homes. And so they're going to hire some part-time contract physical trainers to provide this service to their clients. They charge about $40 per session, and they pay their physical trainers about $16 a session. And the business owner thinks they need a loan of about $15,000 for 5 years to get the business off the ground. And they're going to invest $3,000, so they'll have $18,000 of capital initially to start their business. And so we want to ask and answer the questions of how much profit will this company generate, and when can this $15,000 loan be paid off? So let's jump in. And there's a lot of data here, and we'll zoom in a little bit, but just to set this up, and this is a little bit dated, but this company was started in August of 2020, and we'll assume that's today. And they're going to do this forecast out for 5 years, which is best practice. And it's really interesting here. This is their revision number 4 that they're on. And so, these are never static plans. You always want to go back and revise as your assumptions become better and as you learn more information about your business. And so let's zoom in to the first several months of the business. And so this starts in August and ends in December of this first year, and then goes through the 4 quarters of the second year. And so building out this financial plan really starts with assumptions, right? And so this business owner, again, is doing a physical training company. And so they need to know how many sessions can I do each month, right? And so they start here with 5 sessions in the first month. And I'll also note that actually in the first month of operations of August, they have 0, right? And so they need to get all this stood up before they can actually do some work. And so they start with 5 sessions, pretty small. By the end of the year, they're at 15 sessions per month. And then as they get into the second year, they're at about 25 sessions a month for the first quarter, or 75 for the quarter. And then they get up to about 36 or so sessions per month for actually the fourth quarter. So about 110 sessions for the quarter. And so you can see the assumption here that the owner is making, that they're going to grow pretty rapidly, which is fine. And they can also assume now, how many part-time trainers do they need to hire in order to service these clients, right? So you see they go from 2 initially up to 10 at the end of the second year. So again, these are all assumptions that we would make. And then based on that, we can calculate what the revenue is going to be. I think we said the revenue was going to be about $40 per session. And now we know how many sessions we're going to assume we're going to do. And so now we can calculate the revenue. So starting with $200 a month up to $4,400 for the final quarter, right? So definitely you see growth there. So we have the revenue line established with a couple of assumptions and calculations. And then we want to look at our cost structure. And so we start going through, okay, what costs do we need to run this business? We need obviously the trainers, right? And that's going to be a variable cost as we ramp up our sessions. We'll need more trainers, right? So that cost goes up. We need to reach out to probably like Indeed or one of the job boards. And so we need to pay somebody to find these trainers, right? So we have some expense there initially, and then that expense, as our trainer grows, our expense grows as well. We have a website, right? Probably pretty important these days to set that up. We have some legal costs to get our company set up, establish our LLC, things like that. We have some marketing costs that initially are pretty high and then kind of steady state, and then they ramp up as we increase our business. We have some insurance. We have some initial supplies, a pretty big $5,000 expense here initially. And then we have interest on our loan. So we said we're going to take out a $5,000 loan. Looks like it has 11% interest rate. And so we have some interest expense here that we're gonna pay out to the bank. And so if we look at our revenue, so the first month we have no revenue and we have about $6,500 of cost. So we have a net loss up here of $6,500, and then we have a tax credit of $1,100. So we have a net income or net loss of $5,400 for the first month. So you can see the first month was pretty challenging, obviously. But as we move forward here, when we start generating some revenue, our expenses kind of come in line. We do still have a net loss, which with most startups, that's to be expected as we ramp up our business. But we have a net loss all the way through the end of the first year, all the way through Q3 of the next year. And then not until the fourth quarter of that second year do we start generating a net income, right? Because we've got our number of sessions probably maxed out where we want them. We got our cost structure generally where we want it. And so we start generating a net income. And so that's a very simple example of how you would start setting up your financial plan for your business. And then also we want to look at, okay, what does our cash flow or our checking account look like, during that time period? So we start out with $18,000 in the bank because this is the loan of $15,000 we got from the bank plus the $3,000 that the owner put in. So we got $18,000 sitting in our checking account. We've got a net loss for that first month that I mentioned of $5,400 because we had a pretty big expense here for supplies. And so now we have about $12,600 sitting in our bank, and we have this loan outstanding as well to the bank at $15,000. And so as we move forward here, if we go to the end of the first year, we've got about $10,700 sitting in the bank because we've had some small net losses over the periods. Plus, we're repaying our loan of about $250 a month. So we have about $10,800 sitting in the bank at the end of the year, and our loan balance is now down to $14,000 since we've been paying the principal off. And then if we look at the second year, we have about $6,000 sitting in the bank, right? Because we started with the $10,007. Plus, remember we said we had net losses through Q3. We've been paying our loan back about $750 a quarter. And so now we have about $6,000 in the bank, and our loan balance is now lower at $11,000, which is good. And so at this point, we're looking okay. We have cash in the bank, and we're paying down our loan. And then as we kind of zoom into the later years, so we've already looked through 2021. So if we look at the full year of 2022, now we have still about $6,000 sitting in the bank, which is good. We're starting to have some net income, about $2,800, and so our business is starting to get profitable, which is awesome. And we're paying down our loan. Now our loan balance is about $8,000. And then fast forward through a couple of years here to 2025. Now we have about $7,500 in our bank because we're now generating income that we can put in the bank. And we are continuing to pay off our loan. And lo and behold, by the 5 years, we've actually paid off our loan, right? So we answered our question of, what is our profitability going to be in the early months, early years, later years? And hey, are we going to be able to pay off this loan? And the answer there is yes. So, so kind of just want to show you, why it's so important to do these plans up front, make these assumptions, and answer these questions. So very interesting. So why don't clients do financial plans? So this is, as mentors, this is what we see from our clients. And so, clients, they, it requires forecasting or estimating the future, right? And that's it's not real comfortable for a lot of people. But I think if you just step back and say, okay, do the research and estimate, right? If you're getting into this business, you probably know a little something about it. So just like we saw in the prior example, they're making assumptions about, okay, how many of these services can they provide each month or each quarter, each year? So you just have to step back and do the work and put the assumptions down. Use your actual experience again. You're getting into this business because you probably know something about it. You have to make guesses at times. So we call them assumptions, but at the end of the day, they're guesses. And we'll say that inaccurate estimates are better than no estimates, right? So an inaccurate financial plan is better than no plan at all, because you can always go back and do iterations on that plan. Some of our clients are uncomfortable with numbers, right? And can definitely relate to that. But you'll get comfortable with practice, especially if you do some of these exercises, either on a white piece of paper, right? Or use Excel or some other tool to do them. I think once you go through them, you get comfortable with the math and how things work. They need to look at their personal checking account statement each month, which, if you're like me, you probably don't do it each month, but you need to get in the habit of, probably checking it, if not monthly, weekly. So cash is very important for small business. And like I said, learn spreadsheet softwares like Excel, Numbers, or Google Sheets, can really help you automate and kind of make some of these worksheets dynamic, so you can do what-if analysis. And financial plans are really like a compass instead of a GPS. They're not precise, but they are directionally correct. Again, this goes back to a lot of assumptions that are made, and you can always update them with new information. That's why I think in the example they were on iteration number 4, because as you get more information and new information, you're able to go back and iterate and update these plans. So that's what we're seeing from clients, and some things that we can do, or you can do to kind of mitigate those. So next we'll jump into very briefly bookkeeping. So bookkeeping is kind of that critical component of financial management. A lot say it's very tedious, and being an accountant by training, I do see the tediousness of it, but I also see the benefit of doing it. It's an organized process of really tracking all income and expense transactions, and it's the basis for all financial management decisions, financing, taxes, owner's draw, and retirement. So without bookkeeping, you can't answer all these questions that we need to answer to run our business. And so 10 basic steps of bookkeeping. So start with paper, spreadsheet, prefer spreadsheet, and then obtain business accounting software, right? So you can do QuickBooks or some other type of accounting software like that to automate. But I've always found it helpful to really start with paper, especially if you're starting your own company. Work through the math, understand the mathematics, and then you can move that over to a spreadsheet. And then once you get into the accounting software, you'll fully understand the ins and outs of what's happening within the accounting software. Definitely open a separate business checking account, from your personal checking account, so you can keep your business finances in a separate bin. Very important. Reconcile your checking account. If you're like me, you're not good at doing this, but for a business, it's very important to reconcile, so you know what's going in and out. Track your sales. Make sure you deposit all sales, right? That you're not depositing them in the wrong account, or make sure they're all put in your business checking account. Write business checks for business expenses. Don't mix business and your personal, because it gets very messy very quickly, especially for your accountant. Obtain a separate business credit card. Pay your business expenses first. Generate your profit and loss statement, and pay yourself with an owner's draw. So just some quick basics there for bookkeeping. And then for financial management software, it's really easy to organize and complete daily accounting tasks with these softwares, whether it be QuickBooks or others. They do create automatic accounting reports, such as your cash flow and income statements. They help you track the financial health of your business. And kind of like we say, begin with paper and spreadsheet to run your business, and then use the software. It's a really great way to make sure you have the fundamentals down and the mathematics behind it. Okay, next we'll jump into financial statements. And I want to try to kind of demystify financial statements for you, because this, like I mentioned early on, financial statements can be a little bit daunting for folks that aren't financial folks by training. And so we'll talk about the cash flow statement, talk about the income statement, also called profit and loss, and then we'll look at the balance sheet. And so the cash flow statement is a statement that is for a specific period of time. And so this could be for a period of time, a month, could be a quarter, it could be a year. And the cash flow statement starts with the beginning cash balance. And I like to relate this, like I did earlier, to your checking account. And so if you think about how your checking account works, right, each month you have a beginning balance, and then you have things that go in, things that go out, right? Maybe you have a payroll. If you work for a company, you have cash coming in. Same thing with a company. You have sales collections, you've got contributions that you as an owner have made into that checking account. You have loans that you've received from banks for your business. And so you have these cash inflows. And then you also have cash outflows in your personal life. This would be, checks you're writing for your mortgage, or checks you're writing for, expenses, things like that. In business, you have assets that we're purchasing, assets to produce our products. We have inventory that we're purchasing, inventory that we're purchasing ahead of time to sell to customers. We have expense payments, kind of just like in your personal life. We have loan payments back to the bank. We have owner withdrawals. And so if you take your cash inflows less your outflows, that will give you your ending cash balance. Same thing in your personal checking account, right? So I think if you relate those two, the cash flow statement becomes a much simpler statement to digest. And then just an example here of a cash flow statement. And so this pet care example, so we start with cash on hand of $5,000 and for the month of January. We have cash sales. So these are sales that we made to customers, maybe through our storefront. And then we also have collections on receivables. And so this is sales that we made in a prior month, and sales we made to customers that maybe we have a good relationship with, and we've actually extended them credit. And so we're making a sale, but we're saying, hey, we're making this sale right now, but I want you to pay me in 2 months, right? And so that's what a receivable is. And so we have, again, cash sales of 10,000. We collected on our receivables of 15,000 from prior months. So we have total cash that went into our checking account of 25,000. And then we have cash paid out. So we had, cash purchases for our business and some inventory. We had salaries that we paid to our employees, taxes to Uncle Sam. We have other expenses and loan payments that we made back to the bank. We had cash in of 25,000, cash out of 23,000. So we had a net change in cash of a positive $2,000. So 25 in, 23 out, positive 2. And so now we have $7,000 sitting in our cash account in the bank. And so if we push that to the next month, we start with 7,000. Again, cash receipts from our storefront, and we collected on receivables of 14,000, so 26,000 cash in. Purchases, salaries, other expenses. So we have 19,500 cash out. So we had an increase of $6,500 for the month, which is good. So now we're sitting with about 13,500 in the bank. So again, relate this to your personal banking account, checking account. Kind of makes it simple. And very important for small business that cash is king, right? So if this were not as rosy, if we had more cash out than we had cash in, we can quickly run out of cash, and if you run out of cash, you're really out of business. It's that simple. So very, very important financial statement, but it can be very simple if you relate it to your personal life. And then the income statement also reflects a period of time, again, month, quarter, year. And and this one starts with sales, right? So what are your sales for the period? And then cost of goods sold. So how much did it cost to generate those sales? You know, what was the cost of our product that we sold? If we're manufacturing products, how much did it cost to manufacture those sales that those products that we sold? And so if we take sales less cost of goods sold, we get gross profit. And then after gross profit, we have overhead expenses. Just could be things like marketing and some of those general overhead expenses. And so gross profit less operational overhead, less taxes gives you your net income or loss. So a little bit of a math puzzle there, but fairly simple with the end net income, hopefully, or loss. And so let's look at an example of an income statement. And so again, this is pet care example, and we're going to start in the month of January. And so we had sales of $18,000. We had cost of sales of $7,000. So it cost us $7,000 to buy the products that we sold and generated $18,000. And so we had a gross profit of about $11,000. And a very important metric here that I think all businesses should follow is the gross profit margin. And here it was about 61%. So this is your gross profit divided by your sales. And then within this month, we had operating expenses of salaries, utilities, advertising, insurance, and rent. So we had $6,500 of operating expenses. And so our total profit before tax was $4,500. So that's good. And then, so for that point, for that period of January, we generated a profit of $4,500. And then for February, kind of go through the same math. We had sales of 20, cost of goods sold of 7,500. So our gross profit margin actually went up a bit because our sales went up at a higher clip than our cost. So now we have a 63% gross margin, which is great. You always want to see that number either staying flat or going up, preferably. Operating expenses, again, kind of the same list of operating expenses. And so now our profit for the month of February is 6,200. And so we hope that would, continue to do the same thing for the other month of the year. But just to give you an example of the pieces and parts of the income statement. And one important thing here too is that net income doesn't always equal cash, right? So we talked about before about some of the collecting sales on receivables, right? And so if you're granting terms to some of your customers, some of these sales you're actually going to collect the cash in a later month, for instance, right? So it's very important to know that this $18,000 for sales may not equal the cash that you're actually putting in your checking account if you're going to collect some of those sales on receivable. So pretty important concept here that your income statement is not going to equal your cash statement if you are doing things like giving terms to your customers, or maybe your suppliers are giving terms to you and you're actually paying your bills 2 months later. So pretty important concept there as well. All right, so income versus cash flow. So cash flow tells you how you're running your business day to day, right? So very important. We made the point when we were looking at cash flow that cash is king. If you run out of cash, you're pretty much out of business. So cash flow really tells you how you're running your business. Income statement is going to really give you some analytical tools, right, to tell you if your pricing and costs are appropriate to survive long term, right? We'll talk about later how we kind of look at margins and make sure margins are staying constant. Income statement is more analytical, right? Loan repayments, and so the principal of your loan is really a cash flow statement item, and it's not an income statement item because you're just repaying back that loan to the bank. So it's not an income statement issue. Interest, though, is both a cash flow and income statement because you think of interest as an expense, just like a salary expense. And so we do put interest expense on the income statement. And since it's a cash outlay, it also impacts the cash flow statement. And then if we talk about dividends, this is more for more advanced companies. But if you're paying out a dividend, it's a cash flow item and not an income statement item. Okay, and then the balance sheet, this one is probably the most complex, I think, for folks to understand. So I also like to relate this one to your personal life. And so in my accounting training, this is the accounting equation of assets equal liabilities plus owner's equity. But if we switch that equation around and relate this to your personal life, if you think about your personal net worth on your personal balance sheet, you probably own some assets, like you probably own a house, a car, maybe a 401k in your work life. And so you have some assets. You also probably have some liabilities. Maybe you have a mortgage on that house, maybe you have a car loan, things like that. And so you have some liabilities. And so if you take your assets, right, the things you own, and subtract your liabilities, the things you owe, that gives you your net worth, right, in your personal life. So same thing in business. The things that we own in our business, the assets, things like cash, receivables that we talked about, inventory, equipment. Maybe we own some facilities or buildings for our business. And then we have liabilities. We have payables. So this is what we owe to our suppliers, perhaps. Maybe we have a loan at the bank. So these are things that we owe. And then if we take our assets less our liabilities, we get our owner's equity, right? And so owner's equity is really made up of it's the value of our interest in the business, and it equals assets minus liabilities, like I mentioned. So again, relate that to your personal life. And it includes our original investment, right? So original investment that the owner put into the business. It's any additional investment that he puts into the business later. And it's the cumulative profit and loss from our income statement, kind of like we showed early on as we were paying our loan in that one example. And positive, very important, positive equity indicates solvency, right? And so if you can think about your personal life too, if your liabilities are higher than your assets, right, you're going to have a negative net worth. And so same thing in business. If your liabilities are higher than your assets, then you have a negative equity situation, right? And that's pretty bad. And that goes back to cash flow is king. So balance sheet is a point in time, right? So this is a snapshot as of a end of a period, usually end of a quarter, end of a year. And it's what you own, less what you owe is your equity. So again, related to your personal life, and it becomes a little bit simpler, I think. And just an example here of a balance sheet. Again, this is a snapshot in time as of January 31st here. And so we have cash of 10,000, we have receivables of 15,000 that our customers owe us. And we have inventory sitting in the warehouse at 5,000. So we have $30,000 of current assets, things we'll use within a year or so. And then we have some long-term assets. We have some equipment that we're using in our business to produce our product. And then we have depreciation on that equipment. And depreciation is a concept that is also sometimes hard to grasp, but very simply what it is we're taking this equipment and say this is an 18-year life on this equipment, and then after 18 years we'll have to go buy another one. And so we want to depreciate that equipment or add a negative balance to it to actually reflect the current value of that equipment. And so again, if $18,000 piece of equipment, if we depreciate that over 18 years, each year we're gonna add $1,000 to this depreciation bucket. And so after 18 years, we'll have 18,000 equipment initial cost. We'll have $18,000 depreciation. The value will be zero, and it will probably tell us that, hey, it's probably time to go buy another $18,000 or $20,000 piece of equipment. And so again, depreciation is fairly simple if you can kind of wrap your head around. It's really just trying to true up the current value of this equipment, right? And so at this point in time, it's worth about $10,000. And so our total assets are 40,000, right? Current of 30,000 plus our equipment of 40, total 40,000. And then our liability side of the ledger, we've got some payables that we owe to our suppliers. We have loans payable to the bank, and then we have some current liabilities, a big bank loan of 15,000 that I think we talked about earlier. So total liabilities of about 28,000. We have equity here of retained earnings. This is our net income over the years, 3,500, and our owner's investment initially of $8,500, and so $12,000 of equity. So the old accounting equation of assets equal liabilities plus owner's equity. So 40,000 assets equals 40,000 liabilities plus equity. So balance sheet always needs to balance, very important. But hopefully this kind of demystified the balance sheet for you a little bit. Again, if you can relate it to your personal life, assets less liabilities equals your equity. Okay, so lastly, we'll talk about probably, in my opinion, probably the most important thing here is as we built the financial plan and now we're operating our business, we want to go and take the actuals, the actual operations of our business, and compare them back to our plan. And so for forecasting, what we require is an income statement that you do monthly for the first couple of years, and then quarterly for year 3, and then you can do annually for years 3 and 4 and 5. But it's very important, I think, early on to have kind of a monthly look at your income statement forecast, so that you can really make you think deeply about kind of what you're going to do month to month, and also understand your cash flow from month to month is very important. Cash flow statement, again, you can do, first couple of years monthly, years 3 quarterly, and then you can do years 4 and 5 on an annual basis. Balance sheet, though, if you want to do, since this is a snapshot in time, you can do year 1 quarterly and then years 2 and 3, 4 and 5 annually, which is fine. So that's what we generally require for forecasts. Okay, and then so why do we compare actual to forecast? So very important. We do this in the corporate world as well. It's super important to kind of understand how you're doing versus what you said you're going to do. It allows you also to kind of relook at your forecast. Again, iteration number 5 is where we might be after we do this work. And so it evaluates performance compared to our plan and projections. It helps us understand areas of financial strength and weakness, helps us improve our business, right? It pinpoints profitability leakage as a % of sales. And so this is that gross profit margin that we talked about earlier, right? We want to see that, definitely going up, but also if it's flat, that's okay. But we don't want to see it going down. And again, it gives us basis for corrective action ultimately. Okay, so let's look at an example here. So this is an income statement. And so, we did our forecast at some time in the past, and now we've operated for this month of January. And so we want to go back and look at our actuals versus our forecast. Okay, so we first thing we see here is that sales has gone down by about $2,000. And so, probably want to ask ourselves, okay, why did that happen? Was it a pricing issue? Was it a volume issue? Did we not sell as many widgets as we thought we were going to sell? Cost of goods sold is actually higher, right? On lower sales, which is concerning. So again, we need to ask some questions there of why did our cost go up versus where we said they would be? And we can see our gross profit margin is actually going down, which is or it's lower, which is not good. Said we're going to do 70% gross profit margin, we're at 61%. So why is that? And again, I think we'll answer those questions as we go through the sales and cost of goods sold. Our expenses generally came in line, but I think if you look at it line by line, salaries were higher. That could be concerning if that's a trend. Maybe that would lead us to actually increase our price if we need to. Utilities were a little bit higher, not a concern. Advertising, we didn't advertise or spend as much as we thought we would. If we would have spent more, would it have increased our sales? Not sure, but maybe we could explore that as one opportunity. And so we forecasted to make $7,600. We make $4,500. So difference of $3,100, which is pretty big. So that's definitely something we want to go back and understand either how to change in the future to increase our actuals, or we may, if we can't find ways to change, we may go back and do our forecast again to say, okay, if we reforecast this, are we still going to be on a path to have a ongoing concern or a profitable business, right? So very, very, very important here. Okay. And so if we look at, so if we look at the cash flow statement here, before we look at the financial statement. So cash flow, so here on the forecast, we said we were going to start with 5,000, and we actually did, which is obvious because that's So we knew what that number was going to be. But we had our cash sales here of 12,000. Actual came in at 10, so we were 2,000 under. I think you saw that on the income statement. Our collection of accounts receivable was actually lower as well, right? So we would probably ask ourselves there, are there some customers that aren't paying per the terms and agreements that we set up? If that's the case, probably need to reach out and make some phone calls. So there's maybe some things we can do there. Cash paid out, and so our cash purchases were actually higher. I think we saw our cost of goods sold was higher too on the income statement, so that makes sense from a cash flow perspective. But we want to, kind of answer that question: why are our costs going up? Obviously, salaries are going up. We saw that on the income statement. We want to ask that question as well. Why are salaries going up, or why are they different? Taxes, other expenses, loan payments. Obviously, we look into those too. But from a cash flow perspective, we said we were going to end with $5,500. We actually ended with 2,000, right? So $3,500 difference with this, which is huge, especially in a small business. You run out of cash, you run out of business, right? So this becomes concerning from a cash flow perspective, and really, says, hey, we really need to figure out what we're doing here, and how do we get back to a better cash position, right? So again, can't emphasize enough, this is, so important to do. All right, so how to start, right? So I know a lot of people are just starting their businesses, and so wow, this is a lot, right? So how do you start? So again, like we mentioned before, so have a business checking account in addition to your personal checking. Run all sales and expenses through this business checking account. And this gets back to just the fundamentals of bookkeeping. It really helps to make it much simpler if you have all of your business expenses and transactions in one account. Don't mix business and personal. Analyze monthly business checking account statements. Some banks will do this for you. And then how to analyze some of the stuff we just went through, right? So so starting with pen, paper, and calculator, again, it feels like that's how I started, and it, again, kind of gives you the fundamentals of what's going on. Personal software, Excel, Google Spreadsheet, things like that, are really, really good tools, and they're fairly simple to use. And software like QuickBooks, Zero, Wave, I think I've used Wave in the past. Some of these are helpful as well, and kind of helps you to kind of automate some of these processes. Mentioned a lot of webinars early on, so keep learning, right, about financial topics, especially. Use these recorded webinars. Definitely use our SCORE mentors. If you haven't already, you probably need to have an accountant in your life that's helping you as well. Some online topics and other business people. Very important just to keep learning, right, and definitely use our SCORE mentors. And so just to conclude here, so it all starts with proper planning, right? This financial plan is so important. When you're out of cash, you're out of business. Analyze your cash flow and business performance. Super, super important. Keep good records. And as you look for bank loans, so banks are really looking for the 5 C's, right? Do you have the capacity to pay this loan back? Do you have the capital in your business? Do you have good credit? Do you have collateral? Right? We talked about some of the assets in the business. Banks will look at that as collateral for this loan. And what's your business character, right? Do you have good character in the business community? So all very important there. And select an accountant that specializes in small business. There's a bunch out there. Use our mentors as well. So important. Build and use meaningful financial statements. Our software that we talked about can help. QuickBooks and others. But make sure you're building those financial statements. Those forecasts that we talked about. If you are working with a bank, work with one that understands small business. A lot of our local banks do. Set up an advisory board in your life, in your business, to provide that mentorship. Can't stress that enough, just to have people that have been through this before that can kind of help you over some of the roadblocks that you face. And maybe for us, most important, use our SCORE resources. It's so important there. We have mentors that are willing and able to help you guys. And so with that, I think we're done. And I just want to give a thank you to the organizations that support us and enable us to do this for you guys. So with that, I think I'm done, Laura. So we want to open it up for some questions here.
Let's do that. We have some already. So can I do a one-page high-level business plan that includes a paragraph of finances?
Well, I would probably not agree with doing a paragraph or a qualitative um, financial plan. Again, I think you need to go through the numbers and do a qualitative financial plan. I think we kind of outlined that. You need to make the assumptions about how much of the product are you going to sell, what is your selling cost, what is your selling price, so you can really understand where's your net income, or maybe when is your net income going to come over the years. So I think it's very important that you actually lay out that financial plan quantitatively. Yeah.
Is it possible to overestimate on a bank loan and return the overage
Mm.
to reduce your repayment plan, or will the bank loan have to be renegotiated?
Yeah, it's probably on a case by case basis. But generally, if you want to pay back your loan early, I think the banks will probably go for that. But again, that's something you probably want to make sure upfront. If you do have an inkling that you will be able to pay that loan off early, just make sure it's in the term and agreement with that loan.
This is, please explain the time intervals in the statement. I'm referring to the earlier document that had 5 months, the
Mhm.
Q1, Q2, et cetera, through year one, year two.
Sure. Yeah. So like we mentioned, we really recommend that when you build your financial forecast or financial plan, that for that first year, probably the first 2 years, that you're actually building that by month so that you can see month by month, not only how your net income is going to look, but also how your cash flow is going to look. And then as you get into the like years 3 and 4 and 5, you can really start looking at that on a quarterly basis. And then on the out years, like 4 and 5, you can probably do annually. And we say that because as you look in the out years or you get to those out year periods, your assumptions become a little more murky, right? Because it's so far out. Um, and so I don't also want to say it's less important, but it truly is, right? So you really don't need monthly look at that. So, but those first years, it's very, very important to have really a monthly look at how you're going to do financially from a income statement, financial statement, and a cash flow perspective.
All right. How do you calculate the gross profit margin again?
Yeah, so gross profit margin, that's going to be your gross profit. So if we walk through, you have your sales, then you have your cost of sales. So sales less cost of sales gives you your gross profit. So if you take that gross profit number and divide it by your sales, that's going to give you your gross profit percentage.
Okay. Can you give us a timeline on when each statements need to be generated? What software do you recommend? And also, is there any new AI systems we can use to automate this?
Yeah, oh, good questions. And I'll probably start with the software first. So we recommend QuickBooks, for our clients. It's a very robust, but not not too expensive, right, for a small business, and it's a very good piece of software. So that's the software I think we would recommend. There's others out there that are less robust and less expensive if you want to go that route. Um, but as far as how often should you generate these financial statements? And so I would say if you're a startup company, you're probably looking at your cash flow statement, um, if not monthly, weekly, because again, out of cash, out of business. And so, I think you're looking at your cash flow, at least monthly, and then you'll probably want to run your income statement at that time too, just to see how you did for the month from a net income or net loss perspective. And then that balance sheet, you can also run that one monthly, but again, that's a snapshot in time. Kind of what are your assets, what are your liabilities, what's your equity. And so I would say, whenever you run your financial statement, you probably run them all at the same time, um, just so you have them and you can analyze them. But I would say that you'll probably run the cash flow statements again more frequently. I would say just to make sure that you have cash on hand.
Let's see. What interval would you analyze your cash flow and business performance?
Mhm. Yeah, good question. Cash flow, I think, again, just like I said, I think it's going to be, early on, it'll probably be weekly, right? Just to make sure you have cash on hand. Um, and remember, cash flow is really, how is your business operating? Type of an answer. And when I say operating, how much cash do you have on hand to meet payroll or meet your next, payment to your suppliers, things like that. The income statement is a little more analytical, right? So you probably want to run that, early on, probably monthly, and kind of do some analysis. And this goes back to okay, what did we say in our forecast for this month? Okay, then look at our income statement for that month. Let's analyze where our gross profit is versus where we said it was going to be. Let's analyze where our sales are versus where we said they're going to be. Look at expenses versus, all that analysis that we did on that example. So we probably want to do that early on, do that monthly. As your business grows and you probably become a little more busy and your business becomes profitable, things like that, maybe you do that quarterly and just kind of see from a quarterly perspective, okay, where are my gross margins? Do I need to think about something in the next quarter that I'm going to do differently? And then when you become big like Bridgestone, that's kind of where I operate. We look at ours. We look at a monthly, but we generally make decisions and things like that on a half or even an annual basis. So a lot of perspective there, but hopefully that helps.
All right. Next is Sarah would like to know, can I work with you on creating my 5-year forecast? I'm looking to go for an SBA loan from the bank.
Absolutely. Yep. That's what the mentors are there for, is to help you. What we do request is you need to come armed, right? So you need to have a really good idea of what you're trying to do, right? So with that, you need to have all the assumptions around, and I'm not sure what business you're in, but what are you going to sell? How much are you going to sell? What's your price point? What's your cost structure? Things like that. That's not something that we can do because we don't know your business. But I think if you come armed with those or that knowledge, we can definitely help you put that together. So.
That is, let's see, that's all that's in the chat. So let's look in the Q&A. There's nothing in the Q&A. Anybody else have any more questions? All right, when I'm looking for resources like worksheets, spreadsheet apps, accounting software, etc., free or paid, are there things I should be careful about, or is any okay?
Mhm. Uh, well, I would probably point you to SCORE, because SCORE has a lot of resources on our website. We have templates and spreadsheets and things like that that can help you. And so I would, that's the first place I would go, because it's, because we can trust it. Now, if you're pulling spreadsheets off the internet, sometimes there's an issue there of picking up a bug, right? So we don't want to do that. But I'll point you to SCORE for spreadsheets and templates. Software packages, again, I've used QuickBooks. I've used Wave. Wave is a kind of a free package that I use for my wife's small business at times. Um, you know, and those can generally be trusted. But hopefully that answered your question. I would probably, point you towards QuickBooks, if depending on what size your business is and what you're trying to accomplish, because it can definitely be trusted, and its price point is pretty good. So.
And
Oh, and last part of that was AI. So that's something interesting and kind of near and dear, because we're doing some work at Bridgestone around AI. But I don't know that AI is specifically going to help you here, through large language models and things like that. Um, so there may be AI may be a little bit far, for what we're trying to do here. But anyway, that's kind of where I'll leave that at this point.
will you outline categories of expenses? For example, where would payroll go if we consider all of the statements?
hmm Yeah, so payroll, if you're talking about, well, let me back up. If you're manufacturing a product and you have payroll for the, say your plant folks they're actually building the widgets, that would actually go in your cost of goods sold line, because that's a cost of producing that product, right? And so that's kind of where that would go on the income statement. If you have things like office help or an admin type of role, that would probably go in your overhead expense. So it just kind of depends, but that's a couple of examples I think that might point you in the right direction.
By how much would the failure rate of a new business decrease if all three financial metrics were intact at the beginning? I
Yeah, yeah. It's a good question. I wish I had the answer. I just know it'll be lower than what we presented. And I say that because I know just in my personal life and doing some of these things that if you have a really good business plan, right, that says, hey, I have a plan of how I'm actually going to generate sales and maybe create competitive advantage in what I'm doing. I've got my financial plan laid out, and here's my assumptions, and here's why I'm assuming the growth rates or the number of widgets I'm going to sell. Here's why I'm assuming the price point that I've got in my financial plan. Here's my cost structure, and it's very detailed and laid out. Um, the only thing that can go wrong is that you're wrong in your assumptions, right? But based on your financial plan, again, and you're creating competitive advantage and all that good stuff through your business plan, if all that is right, you know, you should have a pretty good chance at being successful. So hopefully that helps.
Let's see. Dorothy's asking, I think I can answer this, but you can add. If I'm currently working with a SCORE mentor, am I able to get another one who specializes in accounting or financials? So I'll take the first stab at it, Ross. So Dorothy, you with your mentor, they can get the resources for you, or they'll help you if they don't have the expertise. They'll get somebody to kind of co-mentor you. What do you think of that, Ross? Did I?
Yeah, you covered it. Yeah. Yeah.
So they will find the info for you, or they'll find a co-mentor that will help you. And then last question I see here is, since utilities vary based on production, is it a variable expense?
It is. Yeah.
There you
Yeah.
go.
Yeah, very simply put. I mean, there's usually a base load of, if you're running a manufacturing plant, there's a base load of electric and even nat gas that goes through. But electric and natural gas, it is generally a variable expense. Yeah.
Oh, one more. Do I have one more? Nope. Everybody says thank you.
Okay.
All right, everybody. So like I said before, at the end of the day today, you'll get an email with a link to the recording for this, as well as the slides. And then if you want to reply back to me, because it'll come from my office, and you need help navigating our website to find a mentor or to find documents of any kind, just reach back out to me and I'm happy to help you with that. Um, all right. I think that's about it. Thank you again, Ross.
Oh, you bet. Yeah. Thanks, everybody.
All right. Have a good day, everybody.
Bye-bye.